Hello, dear children. Now we are continuing with the second lecture of the chapter Cost and Revenue. So we will start with the behavior of cost in the short run. So we will see how the cost behaves in the short run. Okay. So we already know that there are two types of scales. Okay, of the time period. In the previous chapter also we have learned the same thing, that is short run and the long run. Okay. So we will be discussing how the cost it behaves in a short run. Okay, so the behavior of this cost in the long run has been removed from the syllabus this year, so the long run cost curves we need not discuss. Okay, so we will only discuss the behavior of cost in the short run. So the this short run costs, if you just see it out here, it has the three main costs. Okay, in the short run, that is the total cost. Okay, and then the average cost, and then the marginal cost. Okay, so we will discuss about the total cost. Okay, average cost, and again at the end, marginal cost. Okay, so total cost are also of two types, that is total fixed cost and total variable cost. Similarly, average cost are also of two types, that is average fixed cost and average variable cost. Okay, so let us discuss them one by one. But before we move on to the total fixed cost, variable cost, uh, this average cost, marginal cost, we must uh, have a look at the fixed cost. Okay, one more time. What is fixed cost? By fixed cost, we mean a cost that is incurred on fixed factors. So we already know that be it in the short run or the long run, not in the long run, by the way, because in the long run, all the factors, I mean the output, the scale of output, it can be adjusted. So basically, all the all the factors of production are variable in nature. Okay, so in the short run, one factor, that is uh, primarily labor, is supposed to be the variable. Okay, it is supposed to be fluctuating, whereas the other factors, that is land, capital, and organization, they are assumed to be fixed. So these are called the fixed factors. So the cost that is incurred on the fixed factors are known as the fixed cost. Okay, and the variable costs are those costs uh, which are incurred on the variable factors. Okay, now what is the total fixed cost? Total fixed cost is the cost incurred by the firm on the use of all fixed factors. Okay, now the cost that is involved on land, cost that is involved on capital, cost that is involved on entrepreneurship is termed as the total fixed cost. Okay, and the total variable cost is the cost that is incurred by the firm on the use of all variable factors. We all know that labor, it is a variable factor in the short run. Okay, but there can be other inputs also, like consumables. Okay, in some cases the raw materials. So these are your variable costs, I mean the variable factors. Okay, or the variable inputs, because if you want to adjust, that is to increase the level of output, you have to employ more amount of labor. Okay, or the labor hour. Okay, and for the labor hour you have to pay extra. For example, if in a company there are only 100 employees, okay, and they are being paid a sum of money. Okay, but if they want to increase the level of output, then they have to hire more number of laborers, isn't it? But if they want to increase the labor hour with the same number of laborers, they have to pay them extra for the extra number of hours that they will work. Okay, so that extra cost is involved, isn't it? So the uh, cost that is involved in labor is variable. Whether you increase the number of laborers or you increase the number of labor hours, the cost is variable. It is changing in nature. Okay, so that is your total fixed cost and the total variable cost. So we can say that total cost, normally this total cost. So this total cost is actually the summation of total fixed cost and the total variable cost. Okay, now let us see them one by one. Okay, before we move on to this total cost, okay, before we move on to this total cost, we will see TFC first and then TVC, then finally we will go back to the total cost. Okay, so now what are the features of TFC or the total fixed cost? It is independent of output. So what do we mean by this? Whatever be the number of output, okay, it will be same. Okay, this total fixed cost, it will not change with the change in the quantity of output. If the level of output is increasing, TFC will remain constant. Okay, if the uh, scale of output is decreasing, TFC will remain constant all the time. Okay, so point number two again advocates the same thing, that it remains constant regardless of the quantity of output that is produced. Okay, if the output is increasing, TFC will remain constant. It will not increase. It will remain same as it is. Okay, and again when the output is, let us say, 0, still the total fixed cost will remain constant. Okay, and it includes interest on capital, insurance premium, property tax, wages and salaries of permanent employees. So the interest on capital, or you can say the return on capital, will be constant because you have invested a fixed amount of capital, because we all know that capital is a fixed factor of production. Okay, and again the insurance premium, whatever the insurance premium that you will pay, it remains constant throughout the year. Okay, and again the property tax. So this property, we are actually referring to the land also. Okay, for example, if you have 100 bigas or 100 acres of land, then the quantity of land, that is the fixed factor, it will remain constant. So since it is fixed, then again the property tax that is levied upon will also be fixed, isn't it? And the salaries and the wages of permanent employees will also be fixed. So basically TFC includes all these items. Okay, and TFC is also known as unavoidable cost or supplementary cost, and also as overhead cost. Okay, because the why the TFC is called unavoidable cost? Because in any circumstance, okay, the TFC, it cannot be ignored. Level of output is 0. Let us suppose uh, okay, so let's talk about this coronavirus again. As we all saw that because of this outbreak of pandemic, we saw that the business activities were all stopped. Okay, there was no economic activity. uh, you cannot say that it is completely 0, but yeah, the scale, it had decreased, isn't it? So with that decrease in the activities, did we reduce the cost of TFC? No, it did not. So that's why it is called unavoidable cost. You cannot avoid it any circumstances. Okay, now if you see the graph of TFC curve, okay, if you just want to see how TFC looks like, the TFC curve is a horizontal line, and it is a straight horizontal line. Okay, whatever be the level of output, whether the level of output is increasing or decreasing, it remains constant. Okay, if the level of output is 0, okay, it remains the same. But if it is increasing or decreasing, TFC remains constant in all the cases. Okay, I hope you have understood the feature of TFC, I mean the behavior of TFC. Now let us see the behavior or the feature of TVC, that is total variable cost. Number one, it is dependent of output. Yes, TVC is directly associated with output. When the output changes, TVC also changes. So the same has been explained by this point number 2, that it changes with the change in volume of output. So if output is increasing, TVC also increases. Okay, if the output is decreasing, then TVC, it is now again in return it will be decreasing in nature. If output is 0, TVC can also be 0. Okay, now it includes payments of raw materials, wages and salaries paid to temporary workers, fuel and power, okay, and other items, that is consumables. I hope you know what are the consumables now. So we can say that when the level of output is increasing, TVC is increasing in nature, and again when the level of output is decreasing, TVC is decreasing. Okay, so that's it. You just have to keep this in mind. Whereas TFC, it doesn't change with change in output. Okay. Now TVC is also known as avoidable cost or prime cost, as well as direct cost, because it is directly associated with the level of output. Okay, and this is called avoidable cost because it can be avoided in some circumstances. Okay, for example, if there is no demand of a product in the market, okay, then supply, it can be controlled, isn't it? So when the supply is constant, when the supply is made 0, level of output will also be 0 because there is no demand for such a product in the market, isn't it? So why to produce such a commodity? So when there is no production, TVC, it can be 0, so it can be avoided. Now have a look at this TFC curve. Now TFC curve, it looks like this inverted S shaped. Okay, so why it is so? Why it is looking like this? Because of the law of variable proportions. Now you can see that TVC is increasing out here previously. Okay, it is increasing, it is continuously increasing, and again now it goes flat. Okay, now again it increases very steep. Okay, so this steepness, you can see it out here. Okay, TVC at it originates from the this point O, that is it starts from the origin. Okay, and it is concave downward toward the output, level of output. Okay, uh, it indicates that your TVC is increasing but at a decreasing rate. Okay, your TVC is increasing, however, but it is now going flat, isn't it? Somewhere like it's not completely flat, but it's kind of a slanting position out here, isn't it? It is slanted. So it means that with increase in the level of output, TVC initially it increases but at a decreasing rate. Okay, and after reaching a certain point, it now increases at a increasing rate. So why it happens? Why initially TVC uh, increases at a decreasing rate, and again after some point it increases at an increasing rate? So let's talk about this, because TFC is very simple. It is constant. It will remain a straight horizontal line, finished. But TVC is quite interesting out here, isn't it? Just have a look at this curve, total variable cost curve. Okay, it's quite interesting, and it is inverted S-shaped. Why it is so? So TVC, as we already discussed, that it initially increases at a decreasing rate, okay, and then subsequently it increases at an increasing rate. Why it is so? Because of the law of variable proportions, which we have discussed in the previous class. Now, when the level of output is increasing, okay, when the level of output is increasing, initially it increases at a decreasing rate because of the law of increasing returns. It happens because of the increasing returns. Okay, let me just show you out here. Okay, so TVC increases initially okay, TVC increases initially at a decreasing rate as total output increases. So there should be no increases out here. Okay, so TVC increases at a decreasing rate. Okay, in the beginning when total output is also increasing. Okay, because of the increasing returns. When we employ an extra number of labor, your productivity of the labor will be more. Okay, so because of that, we can see that there is an increasing return previously. So because of the increasing return, TVC, it increases at a decreasing rate initially. Okay, but it decreases at an increasing rate. Okay, so sorry, it increases at an increasing rate. Okay, so why it happens? It happens because of the decreasing returns, law of diminishing returns. Okay, because if you employ more and more number of labors, we have already discussed that the productivity it goes down, isn't it? So because the productivity is going down, you have to employ more and more labor force. Okay, so at that point of time, your TVC it increases at an increasing rate because you have to keep on producing more and more level of output. So in order to increase more level of output, as you can see it out here, the level of output is increasing. Okay, it is increasing, and your cost is also increasing, but it happens because of the diminishing returns. Okay, so please keep this in mind. Now, yes, because of the above mentioned reason, TVC looks like inverted S shape. Okay, and it should be remembered that TVC starts from origin, which states that level of output can also be zero in short run. Okay, so now let's have a look at the TC, that is the total cost. Now we are here. Okay, so first we discussed about the total fixed cost. Okay, after that we discussed this total variable cost. Okay, and now we are talking about total cost. So what is total cost? Okay, so it is derived from both TFC curve and the TVC curve. Okay, so you can see it out here. This is your output. Okay, and this is your TFC, which is constant throughout the production process. Okay, and the level of output is increasing. Okay, and you can see TVC is also increasing. Okay, TVC is also increasing out here. Okay, so initially TVC it increases at a decreasing rate. So let me just show you uh, the difference out here. Okay, the increasing returns and the decreasing returns. I mean the decreasing rate and the increasing rate. So previously, if you just have a look at, uh, just wait. Okay, then 132. Okay, so you can see it out here. When the level of output is 0, TVC is also 0, but the total cost it will be 120. Okay, and when you increase the level of output to 1, it will be 40. Okay, So you can see the difference out here is 40. 40 minus 0 is 40, isn't it? So it is now increasing. Yes, obviously, when the total of, sorry, when the level of output is increased, there will be a cost incurred. Okay. So this is your starting point, that is 40. Okay. And when you increase the level of output to 2, TVC, it will be 76. But it is increasing by 36. So previously it increased by 40, now it then by 36. Okay. And again you want to increase the level of output to 3, then it will be 102, the total variable cost. But you can see the increase out here, the increase is just because of 26. So you can see that previously it was 40. Okay, here in this it was 40, then again it became 36, and then it became 26. So 40, 36, 26, it is increasing at a decreasing rate. Okay, initially. So up to this third unit of output, TVC, it increases at a decreasing rate. But after this point, from sorry, beyond this third unit, when you want to increase the level of output to 4, then again you can see the difference out here is it will increase by 30, isn't it? And again, when you move on to further, it will be now how much? It will be 38. Okay, so it will be now 64. So after this point, it increases. So from 0 to 102, you can see TVC is increasing at an, sorry, at a decreasing rate. But after this point, you can see that TVC is increasing at an increasing rate. Okay, so the combination or the summation of TFC and TVC is TC. Okay, 120, 160, 196, 222, 252, 290, 354. And because of the inclusion of TVC and TFC together, your TC, I mean the total cost curve, will also look like an inverted S shaped. You can see it out here. This red line is a TFC curve, okay? Total fixed cost, okay? And this blue line is TVC. We have seen this. And when you combine these two to form TC, it will also look like TVC. Okay, so this is the basic difference out here. Okay, so please keep this in mind. Okay, so I think, yeah, this example or the table has been taken from the book, uh, page number 137. It's given in the table number 8.1. Okay, so it has been derived from out there. Okay, so when you prepare the data or the table by yourself, you can feed in your own data. Okay, whatever the data that you feel like, okay, you can make it as it is. So it can be 10, 20, 30, 40, or the TFC, it can be 100, okay, or 200, whatever you feel like. And then the TVC also, it can be of your choice. Okay. We will discuss about average cost in the next video.